you remember the movie Raging Bull, right, with Robert De Niro, and what a great movie that was, and what a great job De Niro did. But the bull was down for the 8 count on Friday afternoon, and they were getting ready to call it dead and call an end to the bull market from where we were from the peak to the trough, 20%. But then it rallied into the close.
Right. S&P came out and said that if the S&P 500 closed at 38.37 or lower, that we were entering a new bear market. And what happened in the final hour of trading was incredible, really. We reversed all of the daily losses and finished with a marginal gain on the S&P and the Dow.
Yeah. So there was a proclamation about S&P 500. I don't know. It was probably about 1 o'clock or so on Friday, Central Standard Time, that they said it will be 20% peak to trough. And from that point forward, I don't know if the computers kicked in or not, but we've seen this before. There was a rally into the close, but we've seen before in our history, Derek, that we got to 19% and then we turned around and started heading positive.
Right. I remember that was during the debt downgrade of the S&P, actually just after I started at Annex in 2011, that we saw that in August. And really, the sentiment levels have become so negative. I was looking today when the S&P was down substantially. That fear and greed indicator was back down into single digits. The valuation on forward earnings had dropped below 16.5, which is a fair level over a long period of time. And the sentiment is absolutely awful.
It really is. It's awful, but you were going through a cycle change. We've had this quantitative easing for a long time, and that is an accommodative stance by the Federal Reserve, and that is now changing, and they have to change that, Derek, because they have to fight inflation and inflation expectation, and that is an important differentiator.
That's totally true. But, when people, basically credit the bull market entirely to what the Federal Reserve has done, they ignore the fact that earnings actually are up substantially since the pandemic lows as well. And that's why I mentioned the forward multiple now down under 16.5. I mean, that is a much more reasonable valuation than where we began the year at over 21. So there's been a PE compression despite the fact that companies are continuing to earn money. And the real question is, are we going into a recession or not? Will earnings forecasts be too optimistic, or are we getting too pessimistic by just following the gyrations of the market on a daily basis?
Yeah, so let's talk about that. So, of course, a recession is 2 back-to-back quarters of negative GDP, and we think that there's going to be a modification to last quarter's GDP, maybe even into the positive territory, which could eliminate the fact that we could have a recession in calendar year 2022. That doesn't mean it can't happen in 2023. And if that is the case, we might be starting to form a bottom here at 19% off the S&P 500. Clearly, the NASDAQ has gone into that at down 25%. So now is the time that you go, what is causing this? And as you said, earnings are so important. Earnings drive everything. And the fact that if a company sells more things, has more revenue, and has more income, we can put a multiple on it. And as you said, that multiple has come from a 20 down to a 16.5 or so. Right.
And that earnings concern was really highlighted by any number of reports we got this week, which we'll go into in the next segment. And that's really the question. Are earnings analysts too optimistic? Is the slowdown going to be more than we thought? Because many of these reported misses on earnings were really due to supply problems, whether they couldn't get electrical boards from a Chinese manufacturer, or transportation costs are up substantially because of the rising cost of fuel and so on. So a lot of these factors are data points in time, and then we really have to figure out what the underlying trends are.